2008 panic stock market crash was triggered by a tidal wave of major bankruptcies, including Merrill Lynch and the Lehman Brothers. This triggered a drop of around 40% in just a few weeks. Can we see a similar scenario in 2020? We are going to discuss a potential tidal wave of bankruptcies that may come in the next few weeks or few months, and how that is going to have an impact on the stock market. We're also going to take a look at the Federal Reserve balance sheet, how that has been affecting the markets in the recent couple of weeks, and how we're going to be able to position ourselves to take advantage of it. Now we're going to start off with a quick market recap on the bigger picture of the S&P 500. The markets are still making their way down on a downtrend all the way to that support level. We had a massive sell signal on the break of this trend line. Right here we had a nice island top reversal pattern, and we have to remember that this is a topping pattern. So as long as the price remains below it, this remains a bearish technical. Now obviously the price can take it out, and that would be very bullish. But so far we are still on a downtrend, and we are approaching very strong support. The markets are in a very precarious position right now. We did manage to take advantage of that initial drop, which was really the best trade to make in the recent weeks, and a quick bounce all the way to that resistance level. But now we are stuck with a long-term sell signal and the price approaching very strong support. We've got the 200 moving average right here, right where we are right now. We've got the 50-day moving average right below us, and we've also got the 200 exponential moving average. These three moving averages are all coinciding as support below the current price. And we've also got the 295 level right here, which was a huge resistance level back here, which we broke out of, and it is acting as support right now. So if you are bullish on the markets, this is your time to shine. We've got huge support below us. We're starting to get divergence on the hourly chart. On the futures, we're starting to get divergence right here with this low. And if the markets start to take out that low, we're going to see solid divergence at support. So there is no better objective entry for anyone that wants to go long. And obviously the opposite is true for the bears. If we start breaking through these levels with any type of conviction, if we start heading below that 295 level, that would require enormous selling pressure and would be very bearish, and that would put the false breakout scenario that we discussed right here. I talked about a false breakout as this was breaking out. If we start to get back below that level, that would make this entire breakout a false breakout and would likely trigger much more selling to the downside. Of course, until that is broken, we are at resistance, and the objective trade is a bounce. Anyone trying to short the markets right here at such a strong support level is crazy. You have to wait for a sell signal. Now let's take a look at the Federal Reserve balance sheet. Make sure to like and subscribe if you enjoy this video. It really helps the channel out a lot, especially when having a public opinion on the stock market is so controversial. This is the last 6 months of spending by the Federal Reserve. You can see they started really increasing their spending right here at around the 24th of March. And this actually marked the precise bottom for the stock market. Now, some people could say that is a coincidence, but recently they have started reducing the size of their balance sheet in the past couple of weeks. The size of their balance sheet peaked on the June 9th. And so we can align the stock market to this balance sheet to see how they correspond. This graph was pinned on June 9th. We have the stock market and the Federal Reserve balance sheet on the same chart. And you can see the drop in price of the stock market corresponds exactly to the drop in the size of the Federal Reserve balance sheet. Now, obviously, this does not predict much, but there is one thing I do take away from this, and that is that if the Federal Reserve is not continuously increasing the size of their balance sheet, the stock market starts to drop. such a small drop in the size of their balance sheet actually leads to a significant drop in the stock market. That is a very worrying position to be in for the Federal Reserve. And that's exactly what I've been talking about in the past few videos. The stock market is on steroids. As soon as you take those steroids away, the bubble is going to pop. The markets are overvalued. This is not a stock market I would be invested in for the long term. Now, obviously, there could be still upside left. The Fed will likely continue injecting liquidity into the system. And as long as they do, if they increase the size of their balance sheet again, stocks will likely increase in price as well. So you can certainly make profits to the upside as long as liquidity is being injected. And I do think that is going to be the case for the next few weeks. We can take a look at some articles surrounding that subject. It does seem very likely that a second stimulus package will be coming. Trump assures a second stimulus check, a larger stimulus package. This is something that not many people are opposed to, and so it is very likely to happen. So if you want to ride the Fed wave, which could turn out to be very profitable, you can buy the dip when they start cutting their spending like recently, and then ride the wave when they start to increase it again. Now, the moment that the Fed starts to increase their balance sheet, but stocks continue going down, is when you should be worried. And that is exactly what we're going to discuss with bankruptcies and how that can potentially affect the stock market and let the fear of the market take control over the Federal Reserve. Of course, by adopting a strategy where you ride the Federal Reserve wave, you need to be aware that this is a disguised bubble and that the markets can drop very, very quickly. Just like we saw in March, we're going to go back to the S&P 500. This was probably the fastest drop in price in history. This is not a situation where you want to be stuck in. So if you're going to ride the wave, you need to be very aware of this type of risk. Again, as a buy signal, if you're looking to position yourself for another run up, this support level is very solid for anyone looking to go long. And a break of this resistance level right here would likely trigger a run up to the all-time highs. Now let's discuss bankruptcies. Bankruptcies have a massive impact on the markets. I'm going to show you a list of companies that went bankrupt in 2007 and 2008. These are some of the companies that went bankrupt in 2007 and 2008, and this was their value. You can see towards the end of 2007, beginning of 2008, we started seeing some bigger companies going bankrupt like Bear Stearns, and a bit later on we had Merrill Lynch and the Lehman Brothers, which was followed by a huge stock market crash. One individual company going bankrupt isn't going to make the stock market tank, but having multiple different companies like in 2007 and 2008 going underwater is probably the biggest factor that can bring fear into the stock market and render the Federal Reserve powerless. If investors start seeing big companies like these going to zero, they will start selling. And we may very well see this again in the coming weeks with the retail sector, the oil sector, and even the banking sector again. There are hundreds of companies at risk of going underwater in these sectors. Now, what you have to understand is that these companies have very high expenses and have decreased profits. These companies are currently afloat because of the stimulus check, because of the programs funded by the Federal Reserve. When the Fed starts cutting back on the spending, not only are we going to see the markets tank because speculators are not happy like we've seen in the recent weeks, but we are also going to see a tidal wave of bankruptcies because these companies will not be on their feet yet. I really see this entire rally as the calm before the storm. How long it will last is the question to ask, and the reality is we could still have a lot more upside left for at least another few weeks. Of course, this is my take on the markets. It is my take on the macros of the economy. Do not take my word for it. Go and make your own research, and do not trade based on this video. I hope you guys enjoyed this video. If you did, make sure to drop a like and subscribe if you haven't already. In the meantime, good luck on your trading and see you next time.